Welcome to this comprehensive guide on market movements. Today, we are diving into trend analysis. In the financial markets, trend analysis refers to the specific direction that a market or a stock price follows over a certain period of time. Recognizing this overarching direction is the absolute foundation of making informed trading decisions and understanding where the momentum lies.
Broadly speaking, the market only moves in three distinct ways. We have the uptrend, where prices are continuously climbing. We have the downtrend, where prices are steadily falling. And finally, we have the sideways trend, where prices move horizontally. Understanding which phase the market is currently in dictates the entire trading strategy.
Before we look at real charts, let's establish some crucial terminology. Traders use specific abbreviations to map out price swings. We have HH for higher high, HL for higher low. Then there is LH for lower high and LL for lower low. Finally, EQH stands for equal high and EQL is equal low. Let's focus on the first two for a moment. Higher highs and higher lows are the absolute building blocks of upward momentum. They indicate that buyers are consistently willing to pay more over time, and sellers are demanding higher prices during dips. This creates a staircase effect climbing upwards. Conversely, lower highs and lower lows represent intense downward pressure. When you see these forming, it means sellers are eager to offload their assets at lower and lower prices, while buyers are stepping back, waiting for the asset to become even cheaper before they commit any capital to the market. Finally, equal highs and equal lows occur when the price hits the exact same level multiple times without breaking through. This indicates a temporary stalemate between buyers and sellers, where neither side has enough conviction to push the price into new territory. These levels often form incredibly strong support or resistance boundaries. Let's explore the uptrend, which is also commonly known as a bullish trend. In this scenario, the price action is constantly making higher highs and higher lows. Imagine the price starts at a low point, surges upward to create an initial high, and then experiences a minor fall, which we often call a pullback. Notice this specific drop. If this pullback were to drop below the starting point, it would be classified as a lower low. If it stopped at the exact same level, it would be an equal low. But in a healthy bullish trend, the price reverses well before reaching that previous bottom, successfully establishing a higher low. The defining moment of an uptrend is what happens next. The price must rally from that newly formed higher low and completely break past the previous high. By breaking through that ceiling and closing above it, the market officially prints a brand new higher high, confirming the bullish momentum is still strongly intact. Traders pay very close attention to these pullbacks. When the price falls from a higher high but stays above the previous higher low, this correction phase is closely monitored. These higher low zones are prime areas where traders look for opportunities to enter the market and ride the next wave up. Now, let's shift gears to the downtrend, heavily referred to as a bearish trend. This is the exact opposite of the bullish scenario. Instead of climbing, the price is falling by creating a continuous descending staircase of lower lows and lower highs, showing that sellers are in complete control of the asset. The sequence begins when the price drops from a high point to establish a significant new low. When the price inevitably tries to recover and move back up, it completely fails to reach or break the previous high. It reverses midway, forming a lower high, signaling inherent weakness in the market. In a downtrend, analysts often draw a downward-sloping trend line connecting these successive lower highs. This specific trend line acts as a dynamic ceiling or resistance level. Every time the price rallies up to touch this line, it gets pushed back down, forcing the price to break the previous low and make a new lower low.
Pay close attention to these specific touch points along the trend line. These are critical zones where sellers become highly active. They use these lower highs as strategic areas to short the market, adding further downward pressure and ensuring the bearish trend continues its descent without any bullish interruption.
The final market condition is the sideways trend, which is also known as a ranging market or an accumulation zone. In this environment, the price is trapped within a horizontal range. It simply bounces between a flat resistance level at the top and a flat support level at the bottom. We will explore how to trade these ranges as we move forward. Moving right into the sideways trend, we often call this a ranging market or an accumulation zone. In this scenario, the price is trapped within a specific horizontal range. The upper boundary acts as a resistance zone, while the lower boundary serves as a support zone. The price essentially bounces between these two distinct levels without establishing a clear upward or downward direction.
Because the price is just oscillating, many traders remain inactive until a clear breakout or breakdown occurs. The market is basically taking a breather, consolidating the forces of buyers at the bottom and sellers at the top. For those who trade within this consolidation, the strategy is highly specific. You typically look to buy near the lower support level, setting your initial target at the upper resistance level. Once the price hits that upper target, you can take a partial exit to secure profits. After taking that partial exit, you hold the remaining quantity. If the price manages to break out above the resistance, you are already positioned to ride the new trend using a breakout trading strategy. Let's look at how an uptrend behaves on a chart and how we can map it. An uptrend is characterized by the price breaking previous highs to form new higher highs and pulling back to form higher lows. If we connect at least two of these higher lows, we create a trend line that acts as a dynamic support level for future price action. When the price comes back down to touch this upward trend line for a third time, that is exactly where we look for prime buying opportunities. The historical bounce from these points suggests a high probability of another reversal upwards. However, risk management is absolutely crucial when taking these entries. Your stop loss should be placed just below the previous low or the established support level. This ensures you are protected and can exit the trade with minimal damage if the trend unexpectedly fails and breaks downward. I also want to introduce the one candle strategy for riding an uptrend. When you spot a selling candle during a strong upward move, you mark its lowest point. As long as subsequent candles close above this low, you can confidently hold your position. If a future candle closes below that specific low point, that is your definitive signal to exit and wait for the next clear trading opportunity. It is a simple but highly effective trailing stop mechanism. Conversely, a downtrend consists of lower highs and lower lows. By connecting two or more of these lower highs, we form a downward trend line. In this scenario, the trend line acts as a heavy, dynamic resistance level, pushing the price lower. Every time the price rallies to touch this descending line, sellers become highly active, pushing the price back down. Since we generally cannot short sell in many local markets, we use these rallies to the trend line primarily as zones to exit existing positions. Returning to the sideways trend on a longer time frame, like a weekly chart, you will often see price consolidate for an extended period. When it finally breaks above that resistance with strong volume, it often triggers a massive rally, particularly in lower cap stocks. Frequently, the price will pull back to retest that old resistance line. Because it was broken, it now flips its role and acts as a new support level. This retest is often considered one of the safest places to enter a breakout trade. Understanding these basic mechanics of support and resistance is arguably the most important concept in all of technical analysis. Seriously, you can become a highly profitable trader simply by mastering how price reacts at these key zones. A support zone is essentially an area where buyers are so concentrated that they completely dominate the sellers. Let us jump right into how we actually draw a support zone on a chart. When looking at a price reversal after a drop, the goal is not just to draw a single thin line. If there is a small selling candlestick or a red candle right at the bottom, we want to look closely at its structure. Instead of a single point, we capture the entire lower body and wick of that candle to form a box. If there is no clear small candle, we focus heavily on the closing prices of the candles in that bottom cluster. This area becomes our foundational support zone. Once we have identified that cluster or specific closing price, we extend that rectangular zone all the way to the right. This visual projection is critical. It shows us exactly where we can expect buyers to step back in when the price eventually returns to this lower level. Now, identifying a resistance zone follows a very similar logic, but in reverse. First, we must pinpoint the absolute highest point, or the highest wick of the recent upward move. That peak is our starting point for drawing the resistance boundary. But we do not stop at just the wick. We expand that zone downward to include the closing prices of those peak candles. By combining the absolute high and the dense area of closing prices, we create a robust resistance zone where sellers are highly likely to be waiting. Understanding the psychology behind these zones is what gives them their power. When price drops back into a known support zone, market participants remember the previous bounce. They know buyers were active here before, which creates a self-fulfilling prophecy of demand. Because everyone anticipates a reversal, traders start buying. This collective buying pressure is exactly what halts the downward momentum and forces the price to move upward. It is purely driven by human psychology and the collective memory of the market at that specific price level. When planning a trade around these zones, risk management is absolutely essential. If a trader buys within the support zone, they must place a stop-loss order slightly below that zone. If the price closes below our support, the thesis is invalidated, and it is time to exit. The target for this trade naturally becomes the next resistance level. By calculating the distance to the stop-loss versus the distance to the target, traders ensure a strong risk-to-reward ratio. You might risk 2% of your capital to potentially gain 6%, making the trade mathematically sound. Support and resistance are not always horizontal. In a trending market, we use dynamic levels. By connecting two or more higher lows in an uptrend, we create a diagonal support trend line. This line acts just like a horizontal zone, providing a floor for the rising price. Similarly, connecting the higher highs gives us an uptrend resistance line. Traders can use these dynamic channels to plan entries near the bottom trend line and take profits near the top. However, keep in mind that diagonal lines can sometimes be less reliable than horizontal zones. Conversely, in a downtrend, connecting two or more lower highs gives us a downtrend resistance line. Every time the price rallies up to touch this descending line, sellers are likely to step in and push the price back down. It is crucial to remember that in a prevailing downtrend, this line acts as a strict ceiling. Traders generally look for selling opportunities when the price approaches this dynamic resistance, rather than trying to buy against the dominant downward momentum. It is also important to distinguish between major and minor levels. Major support and resistance zones are created by large institutional players with massive holdings. These levels are usually found at the extreme highs and lows of longer timeframes and are incredibly strong. Minor levels, on the other hand, are formed by smaller retail trading activity on shorter timeframes. While they can provide short-term trading opportunities, they are much easier for the market to break through, especially if unexpected good or bad news hits the market. Finally, simply reaching a zone is not enough to guarantee a trade. We need confirmation. If the price hits a support zone, we want to see strong candlestick patterns, like a hammer or a bullish engulfing candle, accompanied by high trading volume. Candle closing prices are the ultimate confirmation. If the price temporarily dips below support but the candle closes back above it, the zone is still valid. Waiting for these confirmations drastically improves trading accuracy and filters out false breakouts. To wrap up our extensive look at trend analysis and market levels, remember these key takeaways. Always draw zones rather than thin lines to capture market noise. Understand that these levels work purely because of collective trader psychology and memory. And most importantly, cultivate patience. Wait for the price to come to your defined zones. Look for volume and candlestick confirmation, and always protect your capital with strict stop losses. Mastering these concepts provides a massive edge in technical analysis.